Hello, in this presentation we're going to record a loan payment including the interest and principal portion within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be entering interest payments and writing a check for interest payments. Before we do that, it's good to take a look at the actual loan on the balance sheet and see what these payments are made for. Then we'll take a quick look at an amortization table, how it's put together, and how it will determine how we make our payment. So first we're going to go to Reports on the left side. We will go into the balance sheet. So I'm going to type in balance sheet here. We're looking for the balance sheet report. And then we're going to change the date to the month we are working in. I'm going to say 01/01/21 to 01/31/21, January 1st, 2021 to January 31st, 2021. We're actually going to be working on the following month, February here, but this is where we ended off at. So we're going to run that report. And then if we scroll down, we're looking for the liabilities. So here are the assets, here are the liabilities. We have then this 72 loan payment here. So this loan amount. This is the amount that we will be working with. So if we click on that amount, then it started off at 22, the original balance we put in place, and then we had another 50,000. So we're going to have this $72,000 loan. The terms of a loan could be a lot different. We could change from loan to loan. Most of us are familiar with like a car payment or possibly a mortgage payment where we pay a portion of the principal and interest as the loan goes. It's possible for us to have a loan that we just pay the interest and principal at the end of the loan, or we only pay interest as the loan goes and then we pay the whole principal back at the end. We're going to look at this loan as if we're paying a portion of interest and the principal. The other issue with a loan is oftentimes when we get the terms of the loan, they will tell us what the payment will be, and what the interest rate will be, but not the allocation between interest and principal. And that's going to be something that's a problem because it changes throughout the life of the loan. So we don't know how much to allocate to interest and principal unless we have an amortization schedule, something not always given to us at the point of the loan. Therefore, if we're recording the loan, and we don't have that, then we either need to make that, or we can make an arrangement with our CPA firm and our accountant to adjust the loan amounts at the end of the time period. So we'll go through the two methods of doing that. First, we're going to go through the method of making an amortization schedule and then recording the interest and the principals correctly as we go. The other method you could do is just say whatever the loan payments are, you're going to write a check and write it to this loan payable amount, knowing that you're overstating the amount that this will be going down by. And then tell your CPA firm at the end of the year when you do your taxes or possibly monthly to make an adjustment for that. Say, hey, I recorded all my payments to this account. I know there's an interest portion of it. I'm not even going to worry about it because it's not worth my time. I'd like to pay you to do that and adjust it at the end of the year. And then hopefully they can go in there and make those type of adjustments at the end of the year. So either method works. We're going to go with the amortization schedule and see how this loan payment works. So here's an Excel sheet and we'll just do a quick calculation. Typical loan will have the amount, $72,000, the number of months or periods. In this case, we're paying monthly, so 60 months or 5 years, so 5 years paying monthly. The rate's going to be 5%. And then the payment amount they'll usually give you, but we'll calculate it here because it's if we have everything else, then we can calculate the last piece, the last component, in this case, the payment amount. So we'll do that with Excel, and then we'll break out the interest and principal portion per payment, see how those change as we go through the loan process. So the formula for this in Excel to calculate the payment is equals payment, PMT, payment, and then we just go through this little checkbox to figure this out. So we got the rate, the number of payments, and the present value. Now there's a little bit easier of a method that we can use. Excel has up here, and that would be in the formulas And if we choose the formula and that we want to search for a calculation for payment and search for that, then it'll typically find that payment calculation. So when I search for that, we have these items down here. Here's the fair value returns the future value. That's not what we want. We want actually this one. It'll give you the little description down here. Calculates the payment for a loan based on constant payments and a constant interest rate. And it'll give you a little bit more of a detail in terms of a box that will help you give you the description. So it'll give you the description down here. We need the rate. The rate is the interest rate per period. So we're going to take that 5%. Tricky thing is that whenever a loan gives you a rate, that's for a year. And we're doing it every month. So we need to take that rate and divide it by 12. So that's the trickiest thing about this calculation. This is going to be the total number of payments. Number of payments is going to be 60. And then we're going to say that we have the present value is the present value total amount that a series of future payments is worth. We're going to say that that is going to be the loan amount, the $72,000 here. And then if we calculate that, it gives us our amount. Now we're going to basically verify that as we go through the table here, because that's not going to give us exactly what we need. That's just what we write the check for. But there's two accounts we need to break that out to. One, interest, two, the reduction of principal. It also might be good that if we want this to be a positive number rather than a negative number, if we just double click on this and either before or after the equal sign, we're just going to put a negative. And that'll in essence take this entire thing and multiply it times -1. And we'll say, okay, once it after the equal sign, negative, and there we have that. All right, so that's going to be our payment. So within our Excel table now, we're going to have the number of payments here, payment amount, which is always just going to be this. So that's a constant. We know what that's going to be. The interest and principal will change. The principal amount before this is $72,000. After the first payment, it's going to be something less. So there's going to be 60 payments. I'm just going to say this equals this amount here, and every payment we make then will be equal to that same amount. So the amount of the payment will always be the same. That's just given the terms of the payment. So I just copied that down. Then the interest calculation. For the first month, the interest would be $72,000 times 0.05. That would be for a year though, 5% of the 72 principal, divided by 12, because we're doing this monthly, 300. So we're going to say this equals, same thing, 72,000 times 5% divided by 12. That gives us the 300. So of this 1,359, 300 is interest, therefore the rest is principal. So the principal will then equal this amount, the amount of the payment minus the interest. That'll give us the principal reduction. Here's the principal before, and there's the principal reduction. So we're going to say this equals the 72,000 minus the principal reduction. So once we record our payment then, if we have this amortization table, we know that we're going to make a payment, write a check for that. We're going to apply 300 to interest and 1,059 to principal, leaving us on the balance sheet with a balance of $70,941 from that 72,000. The second month is going to be a little bit different, so we'll do this calculation again. We're going to say now we've only got $70,941. The principal has been reduced. Times 5%, 0.05, 5%, gives us interest for a year, but we only want a month, so we'll divide by 12. That gives us the 295.5. We're going to round when we do that calculation here to the nearest dollar. So we're going to say it equals this amount times 5% divided by 12. So notice the interest amount goes down a little bit, but the payment is the same. Therefore, the reduction in principal is the payment amount that's the same minus the reduced interest portion, meaning that the reduction in principal goes down by a little bit as well. So now here's the prior principal, $70,941 minus this amount, and that gives us our new principal. So we'll do this one more time, and then we won't do this 60 times, don't worry. So we're going to do this one more time. I won't do the calculator. I'm just going to put it into the formula here. We're taking this amount, the new principal, times the 5%. That would be for a year, divided by 12 to get there for a month. Then we have that's the interest portion. The principal then is going to be the principal reduction. It's going to be the amount of the payment minus the interest portion, giving us the reduction in principal. The principal amount then is going to be the $69,878 before this minus the reduction in principal. Now what we would like to do is just copy this all the way down. So let's test that. I'm going to copy it down one time, see if it does what we want it to do, and then copy it down again. I'm going to copy this down, and this looks way out of whack, of course. Let's see why. I'm going to double click this, and it picked up this amount like we wanted it to. This number was picking up that amount, and it moved it down just like we want, but it also moved this amount down, and we don't want that to happen. We want to keep it at the 5%. So that's the thing that got messed up. This looks correct still. Everything else looks actually correct. So what we want to do is tell the cell, I'm going to delete this. We want to tell the thing, hey, don't move this cell down when you go down. You can move this cell down. That's what you want to do. That's fine. Don't move this cell down. How do you do that? You use an absolute reference. So we're going to go over here and we're going to make an absolute reference by putting a $sign. I'm going to make a full absolute reference, even though we need a mixed reference, but I'm just going to do the whole thing. And the $signs just mean, that's just like code for Excel saying, do not move the cell when we copy it. Just keep the cell exactly where it is. And that is what we will have. And then once we copy it down, I would do one cell at a time and double check it. That looks correct. That looks correct. That looks correct. So therefore, I'm just going to copy this all the way down. Just going to auto-fill it down. Auto drives it down. Auto's driving it way down to the 60 payments, and Dr. Phil does the calculations, and it ends at 0. So the fact that it ends at 0 means that it looks like we did this correctly. And look what happens to the interest payments as we go. The interest portion goes way down, and the amount that's going to be allocated to the reduction of principal goes way up until it's almost the full amount at the last payment. So that's why we need to do this in order to figure out our payment. So we're going to write a check now for the first payment, which is going to be this item. So here's our first payment that we're going to make. We're going to make it for this dollar amount. This will be the amount we're going to allocate to interest. This the amount we allocate to principal. Now QuickBooks Online doesn't generally give us the split feature in the register account. So we're not really able to put this into the register. We're going to have to write the check, do the check feature in order to write this. So let's take a look at it. So to write this check, we're going to go up top to the little plus icon up top, and we're going to go to the vendors section. That's where the checks will be. We're going to write a check. So we're going to write the check to, we're going to say it's Chase that we're going to be reporting this to. It's a bank. And so we're going to say tab, and it's going to be the checking account. That's correct. We're going to write it from the checking account. We're going to keep that as the address. We're going to say that the date is going to be 02/01/21. This is the second month of operations that we are starting here. We're going to say the check number should remain the same, so we will keep the check number for this time. We're going to keep tabbing through here. We're not going to print it, and therefore we have the accounts now. So remember what this is doing. We're making a loan payment. So the one portion is going to be the loan principal is going to go down. The loan payable amount is going to go down. But it's not going to be for the entire amount. So remember, the entire amount that we're writing the check for is $1,359. The loan amount is going to go down by $1,059. The other portion then we're going to say is in another account. It's going to be interest expense. So interest expense, and you might have to set up the interest expense account. It's going to be an expense account type, and it's going to be an interest expense account type. So if you don't have interest expense set up, we need to set that up. It is going to be an expense, and there'll be a subcategory for interest expense. And then the interest expense is going to be for $300, and that will give us our total then of the check of $1,359 that we are looking for. So we will go ahead and save and new for this transaction, and let's see if it does what we believe it should. So we're going to close this back out. We're going to go back to the balance sheet. So I'm going to go back to the balance sheet up top, or go to reports, balance sheet. And then we're going to change the dates, and I'm going to make the dates for the new month of operation. So I'm going to keep it at January 1st, and then we're going to go through February. So I'm going to say 02/28 and 21 and run that report. So January through February is the report that we need. And if we scroll down through this information, then we have in the checking account, this item. If we select the checking account item and scroll down, we've got the check amount, the $1,359. If we select that amount, then we see our check here. So the check 1,012, here is our amount. Closing this back out and going back to our report, we're then going to go down to the loan amount. So we're going to scroll down to the loan, and here is our loan, $70,941. If we go to our amortization table, then we should have the same amount in the amortization, $70,941, what's left after we make the payment. So that looks correct. And then we're going to go to the profit and loss statement by going to the reports. We'll type in profit and loss. So we're going to say profit and loss, type in the dates of, and we could just do the second month, so 02/01/21 to 02/28/21, so the month of February of 2021, the year we are working in. Run that report. And if we scroll down, all we have then is this interest payment, the $300. Selecting that item, there is our interest payment. So of course, if we go back to the report summary, then that's going to be a decrease to net income, and that's the only activity we have at this time. Now we're going to do this one more time. In essence, we're just going to say that we're going to make another payment as of the end of the month. So we made a payment at the beginning of the month, and we're going to make another payment at the end. So we've done this one, now we're working on this payment, and it's going to be slightly different. So we're going to make this as of the end of the month, February 28th. Same amount, but now the interest will be this, and the principal reduction will be that, leaving us with a principal of that. So let's record the second check. So we're going to go back to our system here. We're going to go up top to the plus, and we're going to go to the vendors and check. And we're going to write another check also to Chase. Checking account. It's going to be, the date is going to be 02/28/21. It's going to be that for the check number. Scrolling through this, we see the loan payment. Note what it did here is it memorized the last check we wrote. And it's tempting just to say to keep these numbers. And typically, oftentimes, that's going to be correct. It's a really great feature that QuickBooks does this. But in this case, we have a difference between the allocation. This is what was allocated last time to principal. Now it is slightly more. It's $1,063. And the interest portion then is going to be $296. Everything else remains the same amount up here of $1,359 going down in terms of the checking account, but the allocation to the other accounts being a bit different to the loan payment reduction and the interest expense. So let's record this and see what happens on the financials. So we're going to save and new here. We're going to close this out. And then we're going to go to the reports once again and look at the balance sheet. So we're going to say balance sheet. And we're going to run this report as of, let's say, 02/01/21 to 02/28/21. And let's run that report. Then we're going to go to the checking account up top. And we'll see that second check. So the same amount, but it's going to be different in nature. So if we go into that check, it's going to be a bit different in terms of this allocation. So we'll close that out. So we've got two checks for the month of February so far. We're going to go back to our summary, to our balance sheet, scroll down to the liabilities section, and we're looking for that loan payable. We have $69,878. That amount matches here, $69,878 on our amortization table. So that looks good. And then if we click on that amount, we see the detail, and it's a bit different. So note the first check went a reduction of $1,059. The second, it's a little bit larger of a reduction because less of it went to the interest expense and more to the reduction of principal. So here's the check. If we close that back out, we're going to go back to the reports, and we're going to go to the profit and loss. And we're going to change the dates from 02/01/21 to 02/28/21 and run that report. And then we see the interest expense once again reducing the net income to a loss at this time. If we click on it, the same amount was paid, but the interest expense allocation is going to be a bit different. Now, of course, we did this in order to show the two payments in 1 month. We wrote one at the beginning and one at the end. So the activity of the reports are going to be a little bit different here because we jumped forward in the month, and now we're going to record some more activity that's going to happen through the month of February.